Welcome to this explainer. Today, we're handing you the master blueprint to a massively complex factory. We're going to completely orient you before we actually walk the floor. You can kind of think of this as getting a drone's eye view of a sprawling industrial landscape. Because, well, before you can even think about managing the micro details of individual costs, you really need to understand the macro environment. Where are these costs born? How do they move around? And where do they finally come to rest?
Now, for literally any product or manufacturing company, we've got to start by recognizing one fundamental truth. Inventory carries massive financial weight. I mean, it's often the absolute largest asset sitting right there on the balance sheet. And what does that mean? It means this represents the highest stakes game in the whole business. When you're dealing with millions of dollars tied up in raw materials, work in process, and finished goods, while even a tiny miscalculation can ripple out into some major financial shockwaves. And honestly, because of that sheer scale, it's also the most complex asset to cost accurately, right? This isn't just about, counting cardboard boxes sitting in a dusty warehouse. Not at all. It's about this incredibly complex journey of accumulating, allocating, and measuring costs from the very first moment of procurement all the way to the final calculation of the cost of goods sold. Every single time a product moves, it carries a financial shadow. And capturing that shadow, that is the absolute core challenge of cost accounting. So before you can manage these costs, you've got to know the map. Our agenda today covers exactly that. We'll start with the biggest balance sheet asset, lay out the 6-phase cost roadmap, meet the people running the cycle, establish the golden rule of control, and finally, look at how cost actually travels. Let's get right into it. Starting with part 1, the biggest balance sheet asset and the overall scope of the cycle. Let's actually define the sheer scope of this inventory and cost accounting cycle. We're looking at the entire lifespan of inventory, and we're doing it specifically through the lens of version 2 of the handbook, what's known as the full cost accounting expansion. Now, this version is a real game changer because it adds some serious depth to how we look at the numbers. Instead of just basic, everyday tracking, it introduces how to actually set up costing systems, build standard costs, and figure out equivalent units of production. It even digs into the, let's face it, pretty messy reality of allocating costs for joint products and handling things like spoiled goods. So yeah, it's the fully loaded view of the whole inventory lifecycle. Moving right along to part 2, the 6-phase cost roadmap, covering 27 stages of cost. Okay, now we need to outline the main roads of our territory here. If we were to personify just a single widget and track its journey chronologically, it actually travels through 6 distinct phases, and each one is driven by specific time-bound triggers. It kicks off with Phase A, procurement and receipt. That happens one time per purchase order as inventory actually enters the business. Then we hit Phase B, cost accounting system setup and standards, which you update annually. Next up is Phase C, manufacturing operations. That repeats per production run or period. Then Phase D is variance analysis, happening monthly to clear out those variances. Phase E is inventory control and valuation. This one's an ongoing process, and it includes things like your lower of cost or net realizable value, or LCNRV assessments. Finally, Phase F, sales and cost of goods sold, and that's triggered by every single sale. So from one single purchase order all the way to the final sale, that is your life cycle. Up next is part 3, the people running the cycle, operators versus overseers. Now, a cycle is really only as reliable as the departments that run it. So let's identify the border guards, so to speak, who own each distinct slice of this work. Notice the stark contrast here between the operators and the overseers. On one side, the operational departments are the folks physically moving stuff around, negotiating shipping terms, and physically inspecting the goods. Meanwhile, the costing and oversight departments, they are the watchdogs. They're the ones engineering the systems and crunching the numbers behind the scenes. Production planning is version controlling the bills of materials, while cost accounting is calculating the cost of goods manufactured and putting together all those variance reports. It's basically a highly choreographed dance between the physical world and the financial world. Which brings us to part 4, the golden rule of control, which is segregation of duties. So every time there's a handoff between those operational and oversight departments we just talked about, it creates a vital control point. And I really want to slow down here for a second because this right here is the iron rule of inventory management. Without strict segregation of duties, the entire accounting system literally crumbles. I mean it. Without it, you leave the door wide open for devastating errors or, honestly, even worse, outright fraud. Let's look at exactly what that segregation looks like in the real world. These groups must absolutely never share responsibilities. For instance, purchasing, receiving, and accounts payable, they have to stay completely separate. The people holding the physical inventory cannot be the same people keeping the final accounting records. The authorization to adjust or write off inventory, that must be totally isolated to management. And perhaps the most crucial one, your physical count team has to be completely different from the regular custodian of the items they're counting. Think about it. If the person who guards the vault is the only one counting what's inside, you don't have a control. You just have blind trust. And that doesn't work.
And lastly, part 5, how cost actually travels, also known as the passports. So we've talked about the phases and the people. Finally, let's look at the passports required to cross these department borders. And those passports? They're documents. Now, documents are not just boring administrative paperwork. They are totally kinetic tools. They are the physical vessels that travel through the phases. They act as the trigger for the very next action. They serve as the irrefutable evidence behind the accounting, and they literally accumulate dollars as they move forward through the cycle. Now, don't worry, you absolutely do not need to memorize this entire matrix right now. Just take a look at how it flows. In Phase A, early procurement documents like purchase requests and goods receipt notes are owned by the warehouse. Fast forward to Phase C, and we're dealing with job cost sheets owned by production. Then Phase D generates all 9 of those variance reports. The big takeaway here is just seeing exactly how each distinct phase generates specific signature records. These are the records that actually enforce that segregation of duties we just talked about, and they seamlessly pass the financial baton from one department to the next. So you've got the map. You possess the overarching blueprint for the entire inventory lifecycle. You know the 6 phases, the departments that guard them, and the documents that transport the cost. But to truly master this factory floor, we've got to ask the next big question. How exactly does inventory enter the business and get valued at its true landed cost in Phase A? Think about it. The second that first shipment hits the loading dock, the financial clock starts ticking. So, are you ready to track that very first dollar?